Every deal you see is built on stack of assumptions. Most of them do not matter much, but two of them carry almost the entire return. And that is what I want to talk about today, especially based on deals I've been reviewing over the past several weeks. So, two assumptions that I'm watching very carefully right now in those deals crossing my desk are particularly relevant for passive investors, active investors, anyone who's evaluating deals. And specifically, I will speak to the multifamily segment, although a lot of what I share can be applied to other asset classes. Now, these are not brand new assumptions or any new trends, but very relevant, namely rent growth and exit cap rates. So everyone knows them, or at least everyone in the space, or everyone evaluating deals. But what is slightly different is how are they being used, how are they being justified, and how much of the return in a typical multifamily deal today is sitting on top of these two assumptions. Now, I'm not going to tell you where the market is going to go, what the market is going to do. The truth is, nobody knows, myself included. But what I want to cover in the next few minutes today during this pop-up live are some of the questions or sharper questions to ask or think about as these opportunities are being presented to you, or perhaps as you're finding opportunities to present to investors. Because the assumptions is really where the deal either lives or dies. But ultimately, we want to make sure that these assumptions are realistic. Otherwise, the deal will look amazing on paper, but a disaster in reality. But before we dive in, for those meeting me for the first time or maybe tuning in for the first time, my name is Vessi Kapulian. I'm a former commercial lender where I oversaw the credit risk for a pretty sizable, north of $1 billion credit portfolio. Most of my career was spent in risk management and underwriting. I started investing in real estate, and now I have a broader advisory practice that works with private investors as well as family offices, advising on strategic investments, risk management, capital allocation, and governance. So let's jump right in. The first assumptions that I want to talk about is rent growth. It's the assumption that feels the safest because for many years rents were increasing, and especially during the period 2020, 2021, in some markets increasing even double digits. And that has changed, as we all know, or at least for those following the market. And what a lot of operators or lead sponsors now deem to be a conservative rent growth rate is what a lot of Excel spreadsheet templates have embedded in them, and namely 3%. So on the foot of 6, 7, 8, 10+%, 3 may seem really conservative. However, the reality has changed from that market environment. A lot of sub markets are really still working through a pretty sizable supply overhang. Now that is gotten better, and it will probably keep getting better, all else equal, right? Assuming no new supply hits the market. But the reality is that in a lot of markets, that has actually resulted in negative rent growth. On top of that, you have a pretty steep increase in concessions. And so the effective rent that a lot of properties are having to charge today in order to at least keep the units filled or full with qualified tenants is a combination of rent decline as well as rent concessions. And so when looking at that 3% that may seem conservative, on paper, that may actually be pretty aggressive or optimistic relative to where the current market and sub-market conditions are. And to add one more factor, if you're looking at a tertiary market, right, again, everything is market specific, but again, 3% on a spreadsheet may seem conservative, but for that tertiary market, perhaps 1.5 to 2% is the long-term historical average. So that's also something to take into consideration. And so that's number one. And again, in a lot of deals crossing my desk, I tend to see that trend, and it's really important to question the assumption, understand where the current market conditions are. And that's why I said the market is one of the first things to really dig into and understand, because the market data really presents the inputs or the assumptions that drive the outputs in those pro forma cash flow models. So there was a deal that was presented to me, and again, seemed very conservative, with like 0% rent growth in year one, and I think then it ramped up to like 6% in year two, and then gradually dropped down to 3% in year three. But for that particular market, the rents had been declining actually 3% year over year. And on top of that, there were a lot of concessions being given in that market. Again, a lot of it being a result of the oversupply. So not only the rent growth assumptions seemed off base relative to current market conditions, but even the concession or the economic vacancy assumptions were off base. So right off the bat, you're starting off with the wrong base, and when you compound that year over year over year, it becomes really, really challenging to catch up, again, unless the market bails you out. Assumption number two, that's again has a pretty potent impact on the pro forma returns, is the exit cap rate. And I did a more extensive LinkedIn Live, YouTube Live last week, so feel free to take a look at it on my page, or if you'd like the link, simply put it in the comments or private message me, and I'm more than happy to share the link with you. But in a lot of deals coming across my desk, I see cap rate compression. It's almost like deja vu going back to 2020, 2021, where people assumed cap rates at that time were already low, and people were assuming that they'll get even to a lower point. Now we've gone through peak rates, and of course, rates are not the only factor that is driving cap rates. There are a lot of other factors contributing to the cap rate trends, but rates being one of them. A lot of people tie that to pro forma cap rates, thinking, well, rates will drop, so will cap rates. But in last week's live, I covered pretty extensively why, in my humble view, that is not necessarily the case. And there was a pretty helpful, at least for me, research paper published by Heinz that I shared in that live, that explains or further substantiates my view on the topic. And so just a quick refresher, right, for anyone who is relatively new to underwriting, the exit cap rate is really the assumption that the operator uses to estimate what the property future value will be, property value at the time of exit. And it matters, right? Because the cap rate is, you can think of it as an inverse multiplier, right? With businesses, they're often valued based on a multiple of EBITDA. Very similar, right? For real estate properties, they're valued based on the NOI divided by cap rate, so an inverse of a multiplier. And so it has a pretty potent effect. And if you get that wrong from the start, again, that's almost impossible to catch up with, unless you substantially increase the NOI level. And so on a typical multifamily deal, that 50 basis point shift in exit cap rate can move the total return but by hundreds of basis points. And so, in a lot of deals today, I see that cap rate compression, which again makes the deal look very appealing on paper, hits the returns that a private investor like myself, or at least the minimums that they would expect. But the question is not what the deal looks like on paper or on the surface, but whether such assumptions are realistic and defensible and achievable. Because um, that asset, right, that will still trade in the market, and the market in 5 years will look at whatever the market is in 5 years. Nobody really knows. So by actually assuming exit cap rate expansion, even a little bit, of course, again, nobody knows where the cap rates will be, but at least you're partially mitigating the risk of market fluctuations. And if the market cooperates and indeed gets better, I view that as the gravy on top. But I certainly don't want to be speculating and hoping that things get better, and have the entire deal hinge on the hope that cap rates will reverse. You've probably heard the saying, "Hope is not a strategy," and I very much subscribe to that. Um, and so, one more thing, when you combine these two, right, rent growth and cap rate, they compound on each other. And so if you get both of these wrong, then the valuation is way off base. And again, really hard to catch up with. And potentially you may be even looking at a loss. A lot of deals are actually going through that as we speak. So, of course, there's a lot more that goes into evaluating the deals. There's a lot more involved in the due diligence process of an investment offering. But I wanted to highlight today at least two of the key assumptions, two of the assumptions that have the most potent impact on the exit valuation, and therefore on the pro forma returns. And I share this with you not necessarily to create any fear or frustration, but to provide you with food for thought and things you can pay attention to next time you evaluate an investment offering, especially if that aligns with your worldview and your investment thesis. And of course, the goal in sensitizing those assumptions, understanding those assumptions, and if needed, dialing down those assumptions to more of a realistic base case versus an optimistic pie in the sky scenario, is not to necessarily avoid the risk entirely, because as investors we get paid to take risk, right? The one guarantee is that you cannot and you will not avoid risk, right? Avoiding risk is impossible, but the goal is to understand the assumptions that carry the most weight, and uh, then determine, right, if they remain durable under pressure. And so if this was useful, feel free to follow me on LinkedIn or YouTube, subscribe to my channel so you can be notified of future events. Next Tuesday, May 19th, I'm hosting my next investor party, and I'll have a special guest, and he will walk us through due diligence and how to better equip ourselves as investors with detecting fraud before it happens, sharing some real life experiences, real life stories. So I have the link posted in my profile, but I will include that in the comments below. And again, thank you for being here. With that said, I'll leave you with one question for your next deal review. If the two assumptions driving most of the return in a model are wrong, what does that cost me? That's a question to ask and to keep in mind, at least one that I think about as I evaluate investment offerings. And it's worth a few minutes to think about it and think of the answer. I wish you a blessed day, and I'll see you in the next live. Ciao.